Hello everyone, and welcome to accounting tutorial. So today, before we move on to another section that I had planned, I wanted to do just a quick little rundown of a couple of example problems, because what I've been talking about so far has been very straightforward examples, and then accounting tests, especially the CPA exam, are not always forward. So I just wanted to go over a couple examples just to make sure we really have this all down pat. So, as you can see here, I just have a couple problems, so let's get cracking. So, given assets are 360, equity is 100, what are the liabilities? Well, this is just simple accounting equation. Oh, by the way, I encourage you to pause the video whenever I ask a question. Try and do it yourself, and then see if you come up with the right answer. So, I'll just let you do that. Okay, so you should be back. Hopefully you have an example or a proposal answer. So, given assets are 360, equity is 100, what is liabilities? Well, this is just a simple accounting equation. So, assets equal liabilities plus equity. So, 360 equals an unknown plus 100. And then, of course, just doing a little bit of arithmetic, 360 minus 100. Liabilities are equal to 260. And those are sort of some beginning problems you might see. Pretty straightforward, pretty easy. But as you can see right here, next example, they can get a little bit more challenging. So, in this case, as you can probably assume, the question mark is what you're trying to find. So you'll be given all these different accounts, and it'll be asked, okay, find the question mark. And then, depending on how much information they give you, you could end up having to find, there can be multiple unknowns. But I'm just going to keep things, give you the idea without making too in-depth a problem. So, given inventory is 220 and unknown accounts payable, cash, yada, yada, yada. So what I recommend how you tackle these problems are first sort all of these accounts into this equation, assets equal liabilities plus equity. So first, what is inventory? Okay, well, inventory is an asset. Accounts payable, that's an unknown. So accounts payable, accounts payable is a liability. So we don't know what that liability is. Next off, cash, that's an asset. Notes payable, well, anything payable, as you can probably see. Again, it's a payable. We owe it to someone, so it's going to be a liability. Inventory, cash, these are things we have in our possession. These are things that, that are assets to us. We use them. Anyway, moving forward, so we got that. Total equity. Now, the reason I'm just giving total equity right now is because how you find equity, the accounts in equity, sort of revolve around a next section that I'm going to talk about as far as the financial statements. What exactly are the financial statements? Because what a lot of textbooks do and what a lot of accounting approaches do is they have you learn a little bit about the accounting equation and then how to put it into these financial statements. A little bit of the accounting equation, then more. I sort of want you to have a really good understanding of the accounting equation, and then I'm going to bring in the actual financial statements. And because of that, the accounts that hit equity are sort of accounts we have not talked about yet. So just hold off on this right now, and I'm just going to simplify this problem just a little bit, and we'll get to equity later, complicating equity later. So for us, I just gave, okay, total equity is 2,000. And then equipment's an asset. So right here. So as you can see here, what I'm probably going to do is total assets, this is total equity, and then we don't know the total liabilities, but as you can see, when you categorize all these accounts in their respective columns and make a totals, you can see right here it's sort of like this problem. We have total assets, total equity. So liabilities, total liabilities has to be the difference between them. So 3,200 minus 2,000, okay, is 1,200. And so 660 plus X, essentially. So 660 plus X equals 1,200, or 1,200 minus 660 is X. So, as you can see right here, this is our answer, 540. So we started off with a bunch of numbers, and we had to categorize them. And then sometimes, like, this is a trick that a lot of, well, not a trick, but just a tactic that you'll have to use. Sometimes you won't know what, like, a specific column total should be, so you have to figure out other totals, total assets, total equities. Okay, now we know what total liabilities should be, and then take it a step forward. If these numbers here equal this total, just use arithmetic. You know, a little bit of simple algebra to figure out what the missing number is. So I just wanted to show you, you know, like, hey, you take this simple problem, given this, this, and this, you know, what's assets, liabilities, or equity, and then show you, hey, it can get a little bit more complicated. And again, a lot of the time the trick is to first categorize and then also be mindful of, oh, do I know these totals? Because again, that little identity of liabilities plus equity equal assets, that'll pop up. And just using all those to figure out your unknowns. And again, depending on how much information they give you, you could have multiple unknowns. So, next, given the situation, put into accounting equation. So again, I really encourage you to pause the video and try and come up with answers as we go along with this. As you can see here, you know, I may put the question here, but this is the accounting equation. And I didn't put dates in any of these, so let's just continue onward. So the company buys $3,000 worth of equipment on account. Now this phrase on account is something I've not really used too often. That just means on account means instead of paying cash, they say it's an IOU. So when I talked in earlier videos about accounts payable, the IOU, that's what on account means. So, company buys $3,000 worth of equipment on account. Well, first, equipment, the asset, will be going up by $3,000. And then what do we have? We're not decreasing cash. We haven't paid cash. But again, we have that liability on account. $1,000. Accounts payable. Bam. A company sells 8 lawnmowers costing $400 each to the customer for $1,000 each, and that just means their inventory is at $400 each. So again, with every time you sell inventory, it's going to have two aspects to it. First, let's take care of the revenue. Well, they sold it for dollars, they said. They didn't say on account, so we can assume that they received cash. So 8 lawnmowers at $1,000 each, $8,000 in cash. Over here, $8,000 in revenue. And then we have to get rid of the inventory because we sold that inventory. What was the inventory cost at? 400, so equals 400 times 8. 3,200 in inventory, 3,200 in cost of goods sold. Bam. Next, Mike starts a company by investing $5,000 of his own money in the company. Mike also buys a $30,000 car. So the first part, really easy. We did that, a lot of $5,000 cash, because again, this is from the company's perspective. So the company received $5,000 in cash, and now there's $5,000 in invested capital. So I believe, I'm trying to remember because I jump around sometime, as far as what did we call our contributed capital. I want to use the same title, because again, there's contributed capital. Sometimes they'll just try and say common stock. Sometimes it'll say owner's capital. So I want to try and remain consistent. Now the next part, Mike also buys a $30,000 car. This is getting back at the separate entity assumption. There's not going to be another journal entry or accounting equation entry. Sorry, these aren't journal entries. Accounting equation entry. Why? Well, because Mike is different from the company. It's his personal car. So I know this seemed like a sort of an obvious trick, but I just want to make sure you're getting used to that. So the fact that Mike bought a $30,000 car, nothing on the company. Now, next part. Company B promises Company A that it will buy $1,000 worth of inventory. Now, I really want you to think about this, pause the video, and then come back. So, what was your journal entry? Or, sorry, not journal entry, but your accounting equation entry? Hopefully, no entry. Now, why is this no entry? Well, Company B promises Company A. But as you can see here, there's no exchange in money. There's no actual, truly, now of course lawyers will say, oh, well, if there's an agreement, then, if there's enough witnesses or a piece of paper, then, but in the accounting world, we do not care about, exactly as much that type of legal aspect. In the accounting world, again, we care about economic substance. It's something that has real substance occur. And unfortunately, or maybe fortunately, depending on your view, a promise is not enough for accounting. So it doesn't matter that Company B promises Company A something. There was no exchange of goods or services, cash, nothing. So there is not economic substance. We're not going to have an entry. Now, the next, Company B gives $1,000 to Company A for future services, no longer inventory, but services. Do the accounting equation for both companies. So first we're going to do Company A. So Company B is giving $1,000 to Company A. So Company A, $1,000 in cash, and then they haven't, future services, they haven't performed them yet. So it's $1,000 unearned revenue. And as far as Company B goes, well, sorry, I have to give myself some more room. As far as Company B is concerned, they paid $1,000. And then, well, this is a prepaid. So they have $1,000 in prepaid services. It could be prepaid rent. It could be prepaid anything. So again, you want to think about the logic and what we're doing. I never showed you before the account of prepaid services, but hopefully you'll be able to see, well, this is the exact same type of transaction we had with prepaid rent, so I'm just sort of going to mimic it here. So prepaid services. Now, this isn't part of the question that I came up with, but let's just say here we want to do the adjusting entry for first A. So the adjusting entry, let's say that, it's like when the actual act is performed, because that's when you would have to make the adjustment, or it'd be what causes the adjustment to occur, I should say. So A actually performs those services. So what would A do? A initially recorded $1,000 in cash, $1,000 in unearned revenue. A actually performs it. Well, now that they actually performed it, you no longer have unearned revenue, but now you have $1,000 in revenue. So you're just swapping this liability, you actually perform the service, now you have $1,000 in revenue. Notice that there's no cash because we already collected the cash up here. The cash is already on our books. So this is where we actually pick up the revenue. Now the adjusting entry for B, they had $1,000 cash, $1,000 in prepaid services. They never expensed anything yet, but they already showed the cash. So now the company performs it. So negative $1,000 in prepaid services, and then over here, negative $1,000 in, we're just going to call this service expense. And again, you know, when you're reading through a textbook, the textbook or a study guide or whatever may make it seem like, oh, you know, there's this very strict account names, and there are a lot of precedents that companies have that we follow as accountants. So, you know, everyone calls it cost of goods sold, or you're not going to see too many deviations from that. But at the same time, if something makes logical sense, prepaid service, service expense. Sometimes, you know, companies will give it a bigger title, prepaid selling general and administrative, you know, whatever, selling general and administrative expense. So just be aware that sometimes these account names, they change a little bit, but just be okay with that, and just to give you a heads up. So now, a company incurs and pays $500 worth of selling expenses. Well, again, we didn't mention anything on account, so it's safe to assume $500 going down in cash, and $500 going down in, well, we're just going to call it selling expense. So again, I hope you were able to get a lot of these journal entries. If not, maybe rewatch the previous video where I really went over, you know, why we put these numbers here and how these account names came to be. And then if you're having any trouble, please make sure to leave a comment and I'll try and get back to you on it. So again, I just wanted to have that as a quick little refresher, a quick little example of kinds of problems that you might see on some type of quiz, homework exam, etc., etc. Well, anyway, I hope you have a great time learning accounting, and I'll see you next video.